morning. You're watching Ask Profit on NDTV Profit. I'm Smriti Chaudhary and with me is Mathew. And this show is all about your stock related queries. So do write to us on any of our social media channels or on the WhatsApp number that'll be on your screen in just a minute. You can also write to us through the YouTube live chat and we'll take your questions from there to our guests for today. But before we do that, let's take a quick check on the markets. You have the Nifty 50 trading 0.5% down, still below 22,000 mark today, and a bit of a weak day in trade today. Let's look at some of the constituents of the Nifty 50 as well and see what's pulling the index lower. You have the likes of Tata Motors, that's down 35 points, and RIL, SBI, Infosys all in the red. On the other hand, you have HDFC Bank, Cipla, Asian Paints slightly in the green today. HDFC Bank contributing about 12 points to the index. A bit of a, and even if you look at the sectors as well, most sectors in red in trade today apart from pharma and the healthcare index. VIX seems to be very high, about 12.5% higher. Very, very volatile day for the markets today. Let's okay, we'll come to Tata Motors, which is falling today in trade, down about 8.5% as we speak. But we'll come to that in just a minute. Let me just talk about a couple of stocks that are moving on the back of results. You have Cipla that's gaining in trade today after the fourth quarter results. You have something like a Sirma that's down as well in trade today. Then there is ABB that's up about over 9% in trade, and that is also on the back of results. It's also hit its 52-week high a while ago. You have Bank of India that's down about 11%. This is also on the back of fourth quarter results. However, on the Nifty 50 index, Tata Motors seems to be the biggest loser in trade today after the fourth quarter results, Alex.
Absolutely, and I don't think it has to do with the earnings themselves.
Definitely, look at the numbers.
Absolutely, you're seeing an expansion on the margin front. You're seeing an expansion for Jaguar Land Rover's margins as well. So what really is the issue? We'll talk about that with the guests that we have on the show in just a bit. But let me go across to our automotive analyst. We've got Puneet joining in to give you some perspective as to why the street is looking so negatively at Tata Motors right now. Puneet, what are the reasons that you picked up?
Yeah, thanks for that, Alex. So stock down roughly 8 to 9%, eroding a market cap of roughly 27,000 crores. And there were 5 key reasons, according to us, that led to this fall. The first one is that the company does not see any kind of incremental growth in its passenger car sales for the next financial year. The company has said that over the past 2 years, the segment has been really, really strong. And going forward, they are seeing some moderation in demand as well. They are seeing that this is also due to a sharp run-up post-COVID for the need of personal mobility, as well as the EV trend over the last 2 years has been really strong. So going forward, they are seeing some demand momentum to be slow. The second reason we could think is the Jaguar Land Rover, the projected sales for the next financial year is really just like flat. According to brokerage Elara Securities, they see just 2% growth in sales over the next 2 fiscal years for Jaguar Land Rover, since it's going into a transition and getting newer models as well. They see also that the competition such as Mercedes and Porsche in this particular segment that compete with them globally will be also a key problem. The third one we see is the commercial vehicle segment, which has been strong for Tata Motors this year, but going forward they see that due to elections the first half will be slow, while any kind of recovery is only expected in the second half of financial year 2025. The fourth reason we see is the order book for JLR. It's declining to roughly 133,000 units and has declined from the previous quarter by roughly 10 to 12%. They also see that, for going forward, the volumes will be flat for this year, as we mentioned. And also on the investment, they are going to spend roughly 3.5 billion pounds in financial year 25, which will lead to negative free cash flow for the company as well. And finally, the post-FAME environment. Now, do know that the FAME 2 scheme has ended on March 31st, and now we are in the new EMPS scheme, where the subsidies have been reduced by roughly 50%. The company highlighted in the conference call that they will be seeing the trend, how the buyers are reacting on the lower incentive schemes. But overall, we see that these were really the 5 key reasons which will be a key problem for the company going forward, and that's kind of reflecting in the stock as well. Back to you.
Absolutely. Thanks so much, Puneet, for wrapping that up for us. If you look at the year to date, and I'm talking about 2024 itself, the stock is still up over 20% despite today's drop. But let's get our expert. We've got Sameer Dalal from Natwarlal and Sons joining in, and we will soon have Rajesh Palviya. Okay, we already have Rajesh Palviya joining in. Thank you so much, gentlemen, for taking the time, and good morning to you. Sameer, I'll come straight to you on Tata Motors. Hopefully you've heard what my colleague had to say about what he thought the key reasons were. What do you make of it, though? And would you say that this is enough of a drop to contemplate getting into the stock if you don't have it, or averaging your cost?
So good morning. So let's first talk about the results. The results were really good, right? Let's avoid the fact that they had the deferred tax write back. So even if we eliminate that, the profitability was extremely healthy. This is on the back of volume growth. You see, the operating leverage for the company played out. Now, two things you got to factor in. One, the management has given a slightly subdued guidance, saying that growth may be a little tapered in the current financial year. And maybe, in FY26, we might see some amount of better growth. But if I look at it on an overall basis, when a company delivers such strong operating margins, and even if I expect vehicle sales to be relatively flattish, I think the profitability will still remain there. It may not grow at the pace that probably the market wants to grow. So that has been one of the reasons the stock has taken a knock, given the fact that growth will slow down. But even when I look at it compared to other players, valuations are cheaper, but they had moved up quite significantly. So, it was kind of like you can say the stock was priced really well. Given the fact that people are expecting slower growth, the stock has come off. Now, my personal take is, yet valuations are not very, very attractive, where I would say that you can go out, gung-ho and say, even after this 7-8% fall, go out and buy the stock right away. I think you will get opportunities. You might see, 1 or 2 quarters where numbers come a little subdued in the fact that sales numbers are lower or flattish, and that could probably pull the stock down closer to the 850 odd levels. At 850 levels, I would definitely be a buyer in Tata Motors. But for the time being, given the fact that the guidance given by the management is not very positive, there's no real trigger to pull the stock up. So whether you're an investor or a trader, the near-term upside to some extent may get capped. But on downsides, from a long-term investor, I would definitely be a buyer.
Okay, fair point. All right, so watch out so buy on dips kind of an approach. Rajesh, good morning. Coming to you on where you see the benchmarks heading. It's a tough question to answer because of the kind of volatility we've seen. But what are the key levels, in your opinion, to watch?
So yeah, good morning. So definitely there is a high volatility. India VIX is at a elevated level. So that clearly giving a sign that, yes, volatility is going to remain in the system for some more time as we are now trading at 20 level of India VIX. For Nifty, 21,800, that almost we have touched that low. So that is, coincide with the 100-day moving average. So 21,800 around is the important support area based on the put concentration at this juncture. But looking at the breakdown which we have witnessed in the previous week, that is very critical for the market to recover from here onward. 21,150, 21,200 are the major challenging level based on the call concentration area. So I think till 22,200, 22,200 not taken out by the Nifty in the coming trading session, that may remain as a challenge for the market. Until these levels are not taken out, there would be pressure in the market. 21,800, and then if it's break, then 21,650 could be the next level on the downside. For Bank Nifty, 47,000 is the key challenging level on the downside. If it breaks below those level, then this fall may extend further towards 46,700. Also on the higher side, 47,600 is the major supply zone for the Bank Nifty at this juncture.
All right, let's start with the questions now. And first question is from Subodh. They're talking about Fed Bank Financial Services. They bought the share at a current price of 125. It's not moving in trade at all today, absolutely flat. But this is from a longer term perspective. Sameer, I'm going to come to you on this one. They're yet to come out with their earnings now. And if you look at the stock performance, it hasn't done too much in the last 1 month. Even in the last 6 months, it's down actually about 11% in trade. What's the long-term view on Fed Bank Financial?
So we don't have this stock under active coverage, but what I can tell you about the entire NBFC space is, to some extent, borrowing costs have moved up, of course, already, and they're continuing to remain elevated. Now, the point is, if Fed Bank is able to pass on any these elevated borrowing costs, then I think they will continue to do well. But I think, we do have Federal Bank under coverage, and for us, the way I would like to play any of these is, why not buy Federal Bank, who has a stake in this as well, and you can get a play on both the banking operations as well as the NBFC operations. So Federal Bank would be my play, but I have no active coverage, so I won't be able to comment on Fed Bank Financial.
Okay, the next counter that we're talking about is Kirloskar Oil Engines Limited. If I'm not mistaken, this is BSE listed. I'm coming to you on this one, Rajesh. If you can pull up the chart, we've got Rohit from Delhi, who's got 100 shares that he's bought at levels of 1,075, and he's looking for a short-term perspective. Okay, it's on NSE as well. It's up as much as 6% in trade today, and his buy price is 1075. So he's still a little away from his buy price. What should his short-term strategy be?
I think he should hold on the position. The way stock is moving across all time frames, stock is holding the ground. On the near-term, short-term structure also, stock is almost trading near to its all-time high trajectory, series of higher top, higher bottom formation. So that clearly shows that there is a sustained buying action is taking place. We have seen a brief consolidation of 2 weeks, and again, fresh breakout is taken place in the stock after today's move. So I think he should hold the position, keep stop loss at around 1040, and possible upside we can see in short term towards 1160 to 1200 kind of zone for the Kirloskar Oil Engine.
All right. The next question is from Prasanthi from Sydney. They say they want to buy out of these 3 stocks, one stock from a longer term perspective. They're all shipbuilders. So Cochin Shipyard, Mazagon Dock and Garden Reach are the 3 counters that they're currently looking at. They want to know if this is the right time to enter either of these stocks. Now, Samir, you look at the counters in the last 1 year and the kind of rally they've had. Cochin and Mazagon definitely they've at least doubled in the last 1 year itself. And Garden Reach, if you look at the 1 year counter, it's up over 80%. Would you suggest buying at any of these counter at the current levels?
So at the current levels, no. Given the fact that they have run up a lot and valuations have moved up. I'm not saying they're expensive, but you see there's many slip between the cup and the lip. And these are very long gestation projects that they get, these shipbuilding projects. It's not like you get the order and within 3 months, 4 months, you finish it and you get the revenue flow. So you've taken orders based on certain price points. Now, if, for example, certain product prices change, you're able to pass on some amount of it, you have to absorb yourselves. And because of all of those difficulties that happen during these long gestation periods, what you will see is at some points, a couple quarters down the line, you will see some amount of margin contraction, or you will see some amount of pain point in the numbers. Now, those will be the right time. So we are not denying the fact that these companies are great long-term wealth creators and will probably continue to remain wealth creators, given the fact that the order flows will remain strong. There are a limited number of players. India is becoming a key player in the global shipbuilding industry. We are a very, very small player, and the opportunities are very large. So we agree on all of those facts, but I would wait for correction. My preferred pick in all of these is Cochin Shipyard, but like you rightfully said, it's more than 100% up in the last 1 year. So wait for a correction. Maybe if you get 10 to 15% lower, that would be a great point. Out of the 3, I would recommend the Cochin Shipyard for you.
Okay. So incidentally, we've got a follow-up, I guess, or a separate question, in fact, on Cochin Shipyard, and I'll take the opportunity to go to Rajesh on this one. We've got a viewer, Swastik, who bought at levels of 805, 500 shares, and sold 250 of them at levels of 1300. The stock is down about 3.8% today, and it's at 1183. So the viewer is still holding on and is making profit. Rajesh, should he sell the rest is the question, or should he buy more at the current juncture?
I think if he's holding this stock for long-term perspective, I think he should use this decline as again buying opportunity, as long-term structure for the Cochin Shipyard is on the bullish side. Though there is some weakness is taken place in the near-term structure. Stock now slipped below to 20-day moving average, but long-term structure is still bullish. So I think if you get any opportunity around 1150, 1160 zone, it's again, a good level again to re-enter in this stock. And we believe that, if 1150 hold out in this decline, then again the stock will start, showing some buying interest. And once the stock manages to cross over 1240, then again there is a high possibility that, stock may regain to its again new all-time high trajectory also. So buy on dip should be your strategy. 1150 is a level where, again, you can re-enter in the stock in this decline.
All right. We'll slip into a short break now, but we'll be back and we'll take more queries on the other side. Stay tuned.
Welcome back. You're watching Ask Profit, and we're speaking with Sameer Dalal as well as Rajesh Palvia. Rajesh, this next one's for you, and this is a question coming in from Tanya Bakchi. She's asking about Angel One, which she's wondering whether to get in at the current market price of at 2,423 for the next 6 months or so. What's the view on the charts?
So there is a sustained supply pressure in the stock, and in this corrective move, stock is making lower top, lower bottom formation. Stock is now slipped below to 200-day moving average also. So that is giving us some sign of further more bearishness for some more time we can see in this stock. We have seen this is the fifth consecutive month where stock is in corrective mode. Though stock is now approaching towards its major important support area, which is placed at around 2350, 2300 kind of zone. So if you get further more dips towards 2350 or 2300 kind of level, then you can buy some stocks around those level in staggered manner. Because still, as you want to buy this stock, because looking at the technical, again, it's a contra buy. So I think wait for further more dips. 2350 would be the attractive level again in this decline. Keep your stop loss around 2280. In the pullback, if the stock manages to cross above 2650, then only we can see some more recovery in the stock, and then possible target 2800 would be there. But at this moment, wait for another fall towards 2350, then initiate some buy.
All right. Next counter we're talking about is KPIT, and this one's KPIT Technologies. This one's from Akshay. They say they bought the shares at a price of 945. It's currently trading above 1400 levels. Samir, on something like a KPIT, they have guided for a strong FY25 growth, but the stock is in a bit of a pressure today. What should somebody who has a longer term view on the counter should do?
Definitely hold on. So the auto, I mean, the segment that KPIT caters to in the technology space is the auto companies. The kind of software, the kind of technology that is going into all of these these companies is only increasing. You're getting even in some of the I will say, how do I put it? The lower end models, you're getting more and more technology inputs, and KPIT comes in with a lot of that. Apart from the information systems and the music systems and all of that, it comes with a lot of other things. So as the penetration for this keeps increasing, as the further increase in battery operated cars increases, I think the opportunity for companies like KPIT, Tata Technologies is quite significant. So I would definitely hold on your viewers making good amount of money. I think he will probably get higher rates 1 year to 2 years down the line. So hold on to the stock.
Sabir, did I interpret your wry smile at the question on the guidance right? Because they've managed to beat their guidance, and people have questioned them in the past, but they've not got it right. But maybe I interpreted your smile right. MapMy India is the next question that we're taking, or the next stock that we're taking, and this is Polomi's question. She's bought 33 shares at an average price of 1,995. Which is slightly elevated. She's lost a little bit of ground. She's asking if she can hold for the next 6 months or so. Rajesh, since it's a short-term query, should she hold on?
I think already stock has corrected. I think she can hold on the position, as stock is now trading near to the important support area of 1740. So I think she can hold on. If stock not breaks below 1740, then possible pullback we can see towards 1840 to 1900 kind of zone. So keep at this moment stop loss at around 1740.
All right. The next counter is Hudco. This one's from Naman from Kolkata. They say they bought the share at an average price of 219 rupees. It's below that price. And Rajesh, this is from a perspective of 3 months. Now, something like a Hudco that has rallied so much in the last 1 year, it's gained over 200%. Do you see more upside into the counter?
I think long-term structure is bullish. Yes, stock is correcting in line with the market, and I think now still stock is holding about 20-day, 50-day moving average. That clearly giving us sign that yes, stock is holding the ground at higher level, and strength is there for near-term to short-term structure also. Yes, definitely one should look to buy Hudco in this correction. 190 should be your stop loss to buy for positional perspective. On the higher side, once stock able to take out 225, then this really can extend to 250 level also. So we are bullish for Hudco with stop loss of 190.
Dinesh has got the next question. 2 counters that he's identified, Cummins as well as Ingersoll Rand, and he's doing an SIP in these 2 stocks. You can say that he's acquiring over a period of time on an ongoing basis. The question, Samir, is should he continue to do this, or should he stop this strategy?
Time being, I think the stock Cummins at least has run up quite significantly, and one can take a pause. So you see, Cummins used to trade at much cheaper valuations in the engineering space compared to a lot of the other competitors. Now the valuations, to some extent, have caught up. Of course, it's still trading cheaper, as an MNC, it's still trading cheaper than a lot of the others. But you might continue to retain that discount because Cummins doesn't have the same kind of profitability margins that some of the other engineering companies do have. Also, you got to realize that Cummins is also to some extent dependent on what happens in the global markets because we do export from here. Cummins India does export to Cummins International as well. And if you see a bit of a slowdown going forward in some of the Western countries, then the order inflow and the growth may not be as significant as like market participants are expecting. So, given the fact valuations are a bit stretched compared to its own historical, I think it's time to probably stop doing the SIP. These are great long-term stories. Again, maybe if the stock corrects at that point, one can restart the reinvestment, but for the time being, I'll ask him to stop.
All right. The next counter we're talking about is Vijay Diagnostic. This one's from Rosemary. They want to buy into this counter. However, Rajesh, this counter has doubled in the last 1 year. Would you suggest buying at these levels or should you wait for some correction?
I think the way stock is moving, I think he should hold on as overall long-term structure for the stock is on the bullish side. Stock is almost trading near to its all-time high trajectory, though there is some correction from higher level, but I think still stock is holding above 730, 725 level. Trend is likely to remain on the bullish side. So I think he should hold on the position. Once his stock again, manages to cross above 790, 800 zone, then this rally can extend to 860 to 900 also. So hold with stop loss of 725.
Got it. Unfortunately, we're completely out of time on this particular edition of Ask Profit. Samir as well as Rajesh, thank you so much for joining in, for answering all the questions that you did. Viewers, hopefully the conversation that we've had today and the stocks that we've discussed have benefited you, even if your specific question may not have been answered. And we'll be back tomorrow at 11:30 to take even more of your questions. So do stay tuned for that. Meanwhile, lots more coming up over the course of the day. From Smriti, myself and the team that put this show together, thank you so much for watching. Do stay tuned. This is NDTV Profit.
Welcome back to NDTV Profit, and today we have the QSR sector in focus, and particularly Safire Foods, who recently posted their Q4 results. And to talk about the company and the future outlook, we're joined by Mr. Sanjay Purohit, who is the whole-time director and group CEO at Safire Foods. Good morning, Mr. Purohit.
Good morning, Mihik, and it's great to be on your show.
Yes. So first, let's start about what's your outlook, and just tell us a little bit about how the quarter went by for the company.
So the last 5 or 6 quarters, in general, we have seen a muting of consumer demand. And this is not only in the QSR segment, but I think right across consumer product companies. This quarter, we grew at 13%. Our adjusted EBITDA was down 3%, and our overall EBITDA was up by 7%. So a muted quarter. When I look at the year in total, within the QSR segment, perhaps Safire Foods has been the outlier performer when I put in all aspects into consideration, which is revenue scale, revenue growth, EBITDA margin percentage growth, and net new additions. So we've grown restaurant sales by about 16%. We've grown adjusted EBITDA by 3%. So, and we've had about 120, 130 new restaurant additions. Apart from that, Safire KFC has perhaps been the number one brand in the QSR industry. We have grown revenue by 18%, and profit margins have actually grown by 30 basis points. So it's been a strong quarter for Safire. And plus, we've had other big wins. For example, we are the number one QSR on the Dow Jones Sustainability Index. We are one of the top 3 franchisees for Yum brands on both KFC and Pizza Hut from a consumer and operating metrics perspective. So while the numbers are slightly muted, the underlying muscle has undoubtedly grown much stronger during the year for us.
Yes. Before I go on to the company specifics, could you maybe give us a demand outlook for FY25? Could there be, sparks of demand revival in the second half of the current financial year?
So we've been calling out that consumer demand has been constrained from perhaps quarter 4 of FY23. So now it's been nearly 5-6 quarters where we've seen this demand slow down. And it's vetted by the private final consumer expenditure metric that the government puts out in addition to the GDP. And that metric has seen the lowest growths over the last 5-6 quarters, over the last 20 years, perhaps. So undoubtedly, there is pressure. And interestingly, there is pressure at the lower and the middle class segment. What seems to be doing well in these pockets is still the premium segment and upper end. So generally, I don't see consumer demand reviving dramatically over the next 1 or 2 quarters. Perhaps after the monsoons, there might be some revival. Having said that, the most important thing that we can do is be in control of our destiny, which means that how do we make our brands more relevant, focus on innovation, advertising to drive occasions of consumption, increase marketing expenditure, and the consumer and operating standards, lift them continuously. So we are focused on what we can control and improve that for the consumers. Everything else will take care of itself.
Okay. And in terms of, given the backdrop of muted demand, what is the capacity addition in terms of stores that the company is guiding for FY25? And how would it be distributed quarter-wise?
So in December 21, after our first results post our IPO and listing, we had called out saying that we should be able to double our stores in 3 to 4 years. Now we feel that KFC should be able to double its store count by the end of this year, so which is in 3 years. In the case of Pizza Hut, our restaurant EBITDA margins have come down to single digit. And when it is single digit, then it doesn't meet our internal hurdle rates on ROCE. And therefore, we are going to be a little more cautious on our expansion. Once we get to the double-digit territory is when we will restart expansion. In Sri Lanka, we are seeing continued cautious expansion there as the economy is reviving. So it's a mixed bag. KFC continues as it is. Pizza Hut, we are cautious till profitability and indeed sales improve. And in Sri Lanka, we are cautious, but we are continuing to expand there.
So would there be any store expansions in Q1 for any of these segments?
Yeah. So typically, I'm loath to give a quarter by quarter guidance, Mika, because much can happen during the quarter. But I think the general outlook that I've given stays.
Okay, got it. And in terms of growth for the overall company, top line and bottom line, for FY25, is it our expectations to be flat, or could we see double-digit growth as well?
So again, our first guidance was to say we aspire to grow revenue by 25% and EBITDA by about 30% and double the store count, as I said earlier, in 3 to 4 years' time. It's been 3 years since we listed, and our 3-year scorecard suggests that we have blown those aspirations perhaps out of the water. We have grown revenue by 37%, EBITDA has grown significantly, and we're more or less on course to double the store count in 3 to 4 years. That's our going forward aspiration. However, again, I'm quite loath to give a quarter and a specific year guidance because much can happen in the Indian economy and there would be ups and downs, but over a longer term trend, this continues to remain our aspiration. Revenue by 25%, EBITDA about 30%.
Okay, got it. Now, first coming to Pizza Hut, now margins were effectively negative 2.7%. When does the company foresee to at least reach the EBITDA break-even level? Could it be this financial year?
Yeah. So undoubtedly, the last 4 or 5 quarters on Pizza Hut have been tough. I've said in a muted economic environment, heightened competition also has taken its toll on the brand, and a number 2 brand perhaps suffers a little more. And therefore, we have said we are going to aggressively push the agenda of the brand. The brand holds a tremendous amount of equity in the consumer's mind even today. I mean, it's finally a brand that all of us have grown up on. It's 25 years old, and therefore it's quite powerful. But we have got to actualize that mind, the power that it exists in the consumer's mind. We've got to actualize it from a wallet perspective. So what we called out 1 or 2 quarters ago is that we want to up our innovation game. We've taken in marketing investment further, and I had called out last quarter that we should see innovation in the next 1 or 2 quarters. I'm quite happy to say that we launched Melts in March, and Melts is quite a unique pizza concept. It's a folded pizza concept. More importantly, it takes pizza consumption into newer territory, the snacking territory as against meal territory. So we've put in significant amount of marketing investment. So you see the Q4 negative 2.7% is largely because of the higher marketing that we have put in. Without that, the brand is actually at break even. So, and as we've gone from Jan, Feb, March into April, May, June quarter, we are seeing a better than normal sequential uplift. Now, I'll be still cautious to say, let me have a look at it over the next couple of months. But the game plan is quite clear. Market relevant innovation backed by significantly higher marketing investment. And on the consumer and operational metrics side, I think we have made big improvements. We launched Dragon Tail, which is a very unique kitchen planning tool. If you see our ratings across our 300 plus stores on Google, Swiggy, Zomato, all of them have seen marked improvement over the last 1 year. So this is what we can control, what is in our hands, make the brand again strong and revive consumer interest behind it.
Got it, Mr. Purohit. And you mentioned the food aggregators and delivery platforms. Now, pizza is a generally preferred delivery category, and it's also reflected in your channel sales distribution for Pizza Hut, 50%. Is the strategy to focus on delivery, or are you going to continue dine-in?
Oh, no, not at all. We've always said that the best way for a food brand to operate in the country is through a omni-channel model. 70% of the investment behind a store goes into the kitchen. And therefore, why would we stop the consumer from accessing the brand across every single channel? So for us, we are channel agnostic. In fact, we say we are omni-channel. Dine-in is very important. Takeaway is very important. Own delivery, aggregator delivery. Right across, I think we focus on all channels. And that's the only way, I believe, to be profitable in the foods segment.
So what's the targeted mix? Is there a optimum mix that Safire Food aims to go to?
Very well. So the mix is slightly different in the case of KFC and Pizza Hut. Post-COVID, we have come to in the region of 40%, 60% dine-in takeaway on KFC and 40% on delivery. In the case of Pizza Hut, it is 50-50. We are seeing reasonable consistency on this contribution over the last perhaps 18 months or so. So it's not changed dramatically at all.
The RBI clamps down on Kotak Mahindra Bank. Sources tell us that the bank's IT spends may not have been the problem after all. The problem was bigger and lay in the prioritizing this budget. Pragati brings us more details on this exclusive story. Pragati, over to you.
Right, Samina, thanks so much. Yes, so Kotak Mahindra Bank is still in the news after RBI clamped down on 24th April. Now, a little bit of more digging deep, and we got to know that sources told us that while RBI pointed out issues in the IT infra or in the tech spends, and all our eyes were on how much the bank is spending on its tech, that may not have been issue because the bank, while it spent about 1,600 to 1,700 odd crore in FY24, the prioritization of these spends as to the fact that these spends were not going towards actually solving the problems was the issue. Now, sources told us, I'm going to list down 4 to 5 points for the benefit of our viewers, is that first, the IT funding or the budget was pretty solid for Kotak Mahindra Bank, but the budgeting of this spending was the issue. The priority was not being laid on solving the technical loopholes, especially in the legacy infrastructure of the bank. Now, sources Sources told us that the bank was using legacy infra, and these systems were not being updated or upgraded as per the latest models, and that is why it could not handle the volume of the online payments that could happen, and hence the significant outages that were reported in the system. The next that we have to see is the lack of employee costs at Kotak Mahindra Bank. Now, what we know is that the way an IT budget is planned at Kotak Mahindra Bank, about 20% of the funds are going towards employee costs or the employee expenses. But sources told us that this was not sufficient, because despite the bank having a huge workforce of about 1,200